Good morning, 5:57 a.m. Pacific Standard Time, 7/18/2011. We got earnings on Wynn after the close. We got IBM today. The worldwide futures are gapping down because of the contagion and the fear as far as European, oh boy, bank stress test. Then we had Geithner come out this morning about the debt ceiling still remains a big uncertainty for U.S. Will the market discount this? Well, it's pretty hard to discount that. So, individual equities will come to support levels from the original bull rallies that they had, but those support levels become very vulnerable. Why? Very little short interest. Okay, we're going to come down and hit key support levels on the S&P 500 as well. So we've got Netflix gapping down again. They love to gap it down to buy it, so we'll be doing a left elbow trade there. Okay, it'll gap to the lower support levels. However, when they do bounce on a 3-minute, 6-minute, 9-minute, if those price actions, if those dollar price movement are contracted, that means that the bounces are weak, and that when they do come to a double bottom, that they're very vulnerable to sell through there at those support levels. As far as understanding where the bull trend is, the further that bull summer rally bull trend pulls back, individual equities at broad-based rally, so they're going to be weak. So the gap open up is Google's 2.26. We like that. It's an intraday trade. The bull is down. Sign in your little culprits in here, okay? As far as Baidu goes, it's a little bit of a left elbow gap down. And if the S&P 500 doesn't hold that 1303 level, 1302 level, which is right behind here, this is the S&P 500, my friends. This is that neckline. This is where we busted through there during that rally. And you're gapping below it right now. And the Dow futures are down considerably. Nasdaq futures were down 21 handles. They're down 13. S&P is down 8.20 at 1306 in pre-market futures. Gold, on the other hand, is screaming. It's up. The Dow futures are down 79. They were down 96. We will take a look at our yearly formulas on the indexes. The trade management, though, is that when they go up to resistance levels, the further that we pull back in the bull rally within an equity and the indexes, is those support levels have really got to hold. And are they wanting to commit ahead of this risk? There's a lot of risk as far as what the U.S. is going to do. I mean, if we break below, if the U.S. doesn't do the right thing, the next support level, if we break this line right here, is going to be slightly above that 200-day simple moving average. So we had a great bull rally over here, but we're pulling back. And if when we're trading S&P 500 stocks, they're going to follow the S&P 500 index. Why is it? Because the leadership in the S&P 500 will sell up at resistance and roll over, and they will break their lower supports as the S&P, because it'll be those leaders that drive the index down. There's 500 of them in here. Now, granted, today is the major day of the earnings, that the bull will still have, well, things are going to be good on the bottom line and the top line. Upside input cost is a factor along with inventories. The financials are going to be coming out reporting. They're going to stink, man. Things like Bank of America, Wells Fargo. There are different parts of financials. You got Goldman Sachs coming out tomorrow morning. So that's the gap open down. And on the flip side, over here, we have a gap open up. We got a PPDI. We got Checkpoint Software. You can see the GOLD. That's a minor stock. And you got a slight gap on Apple. Why is Apple gapping up? It's simple. It's an overbought stock. It's going to go into its earnings Tuesday night, tomorrow night, And it's all about how far can I get that up there, buy the rumor, sell the news, and or gap up, sell the news on a gap. We'll be watching it carefully. Diminishing gap open up. Trade management has been set with the gap open down. Netflix, when it comes up off that bottom, when it hits that support, the lower support levels, is you're looking for 2 times greater buy action 3-minute bar to the last distribution sell bar. And it's on right now. And it's going to be volatile, extremely volatile, because of the earnings may not be a good earnings that come in certain different sector indices, you know, are going to do well, and some aren't going to do well. The question is the market going to use the earnings as the good news and discount the banking system in Europe on the stress test? And I cannot see where that the market will really want to discount the debt ceiling and the things that are a huge overhang that's going to create extreme volatility. Okay, so it'll be a stock picker's market. It'll be relative strength versus relative weakness, and how does weakness build in the indexes, and how do weaknesses start to build from a bull rally back down to the major support level. So we got extremely overbought in a lot of names in a very short period of time. 10, 12, 13 trading days, we got extremely overbought. Now that they're going to pull back from the overbought levels in the indexes and individual names, is how that bull is going to respond to those support levels. Okay? Trade management, Nasdaq, the VXN is a fear indicator. If it stays elevated and is breaking higher, that means that equities are weak. Period.